We all know that we should be saving for retirement, but which retirement account is actually going to work best for you? I mean, you have so many options, a 401k, a Roth IRA. Well, if you've ever been confused, you are not alone. And in this video, I'm going to break down 4 retirement accounts and let you know which one might work best for you. Hello again, and welcome back to my channel. My name is Dr. Brittany Helford, and on this channel, we talk about all things personal finance to build more wealth and more joy in your life. And today we are going to discuss the retirement accounts. So specifically, we're going to talk about the 401k, Roth 401k, Roth IRA, and a traditional IRA. At the end, I'm going to give you a few pointers to determine which account might work best for you. Now, the first distinction in the retirement account is who is sponsoring it. Is it an employee-sponsored account, or is it a self-directed account? So, for example, the 401k accounts are employee-sponsored accounts, and the individual retirement accounts are self-directed accounts. Majority of Americans invest through their employee-sponsored account, and those include 401ks, 403bs, 457s, SEP IRAs, and also simple IRAs. In this video specifically, we're going to talk about the 401k plans, which also are similar to 403b and 457 plans. The second distinction between these accounts is the timing of taxes. For example, if you have a Roth IRA or a Roth 401k, the contributions from those accounts are after taxes, meaning that that money has already been taxed and then you contribute to your retirement account. That is in contrast to your traditional IRA, which sometimes can be funded through after-tax dollars, but you still get a tax break, or your 401k is using pre-tax dollars, which means that it reduces your taxable income for that year. And we'll talk a little bit more about taxes when we speak specifically about each account. Now that we have those two general distinctions, let's look at some of the fine details of each account. In this video, as I mentioned, we're going to speak specifically to the 401k employee-sponsored plan. 401k is a defined contribution plan, basically meaning that your employer will contribute a specific amount to the employee's plan. This can be done based upon the employee's contribution to the retirement or solely without any basis of contribution. And actually, more than 75% of employers contribute based upon the employee's contribution. So let's talk a little bit more about the match. When your employer offers a match, that could mean dollar for dollar up to a certain percentage. For example, if you contribute 3% of your salary and your salary is $100,000, so 3% of $100,000 is $3,000. You contribute $3,000, and if your employer is offering a dollar for dollar match, then your employer would contribute $3,000 as well. Okay, so let's say, for example, that your employer offers a match of 50% up to 3% of the employee's salary. So what that means is that you, the employee, must contribute 6% of your salary in order to receive all of that free money that your employer is offering. It's because 50% of 6% equals 3%, which is the full amount that your employer is willing to match. The 401k is also pre-tax dollars. So that means that that reduces your taxable income. And if you're a high income earner like me as a physician, you want to reduce your taxable income as much as you can, because at the end of the day, the federal government is going to take the taxes that are due. And for high income earners, reducing that taxable income means that you're paying yourself in retirement, your older self, and it's also decreasing the amount of money that you may have to pay back to the government for taxes. Now that is specifically for a traditional 401k where you contribute pre-tax dollars and it reduces your taxable income. And you will have to pay taxes on that money when it comes time for withdrawal at retirement, 59.5, or when you have to take the required minimum distributions, your RMDs, at 72. However, it is a pre-tax contribution. Now, and that's specifically for the traditional 401k. Now, for the Roth 401k, you are making contributions of after-tax dollars. So the government has already taxed that money, and the money that you take home or would take home, your employer then allocates that to your retirement plan, to your 401k. And those are after-tax dollars. Now, at the time of withdrawal at 59.5 or whenever you retire, then you will not have to pay any taxes on that money because you have already paid your taxes on that money prior to its contribution to your 401k. Now, both of these accounts, a Roth 401k or a traditional 401k, grow tax-free, which is great. So as you make gains, you do not have to pay capital gains tax or any other tax. So you're only taxed once for all of these retirement accounts. Now, you've contributed X amount of dollars into your 401k. What happens then? Typically, the money is invested in a target retirement fund, or a TRF as it is commonly called. And a target retirement fund basically calculates when you're going to retire based upon your age. So I'm 35, it would calculate that I would retire at 65. So the money that I'm contributing would be a target retirement fund of 30 years from now. So 2051, that's what it would say for my specific 401k. Now, when you're opting into the target retirement funds, you can select retirement, at 70, age 70 or age 80. Farther out target retirement fund that you elect for means that that target retirement fund is going to be invested more aggressively in the beginning. And as you approach retirement age, then there is a fund manager that will change the asset allocations of that account so that it is not as aggressive. And this is a whole series about investing. And so I am going to talk more about asset allocation, risk tolerance, and all of that in future videos. So make sure you hit that subscribe button right now and turn on that notification bell so you can learn more about how to invest your money to save for now, to grow your money, or to retire in the near future. Target retirement funds are typically mutual funds that contain a diversified portfolio of securities. However, because they are mutual funds and there is someone who is actively managing the mutual fund, they often come with higher fees and also restrictions as far as what types of investments you can invest your money in, what types of securities you can invest your money in. So they're not as flexible as many of the self-directed retirement accounts where you can pick and choose your investments. For the 401k, there is a contribution limit of $19,500. And I would encourage you, if you can, max out your 401k every year, especially if you're a high income earner, because that reduces your taxable income. Now, the maximum contribution for employee and employer is a maximum of $58,000. And that's great if your employer contributes an additional $39,000 on your behalf. For the 401k, you also have an RMD at 72, or the required minimum distribution at 72, which basically means at this age of 72, you are required to take money out of that 401k account. And why is there a required minimum distribution? It's because you didn't pay taxes on that money. So at some point, you have to pay taxes on the money. For traditional 401ks, you pay taxes at the time of withdrawal. And so if you never withdraw that money, then you're never going to pay taxes on that money, and it's just going to keep growing tax-free, and Uncle Sam is never going to get his cut. So that is why there's a required minimum distribution at the age of 72. Now let's talk about the individual retirement accounts, or IRAs. And we are specifically going to speak to traditional IRAs and Roth IRAs. Now, these are self-directed retirement accounts, meaning you have to do the work. You have to open up a brokerage account and actively invest this money. Now, I say active because you have to choose how that money is invested versus having a mutual fund manager, such as in the target retirement funds, that will choose your investments. Now, even in a Roth IRA or a traditional IRA, you can elect for a target retirement fund. However, as I mentioned, they often come with higher fees. After opening a brokerage account for a traditional or a Roth IRA, you can invest your earned income, and it has to be earned income. So it cannot be money that was gifted to you from somewhere else if you do not have any earned income during that time. So for example, many people want to open up a custodial IRA for their children, but if your child does not have a job, then there's no way that you can open up an IRA because it has to be earned income. So my daughter is a model for our Hair Accessories brand, Bramlin and Rose, and she has earned income through the modeling position. And therefore, we were able to open up a Roth IRA in her name using the money that she earned from that job. Usually it's investing after tax dollars. However, your employer can deduct from your payroll and make contributions in that way on your behalf. Otherwise, for a traditional IRA, you can include this on your taxes, and that will therefore reduce your taxable income. So oftentimes traditional IRAs are pre-tax dollars, which means that you would have to pay taxes upon withdrawal of the money from the traditional IRA. So typically when you're thinking about just Roth IRA versus traditional, the Roth IRA or the Roth 401k is after tax dollars. The traditional is pre-tax dollars. And in an IRA, it grows tax-free, just like a 401k. So all of these retirement accounts grow tax-free, and you only have to pay taxes one time. Now, as I mentioned, in the self-directed accounts, they are invested in your desired securities. So if you want to invest 100% of your money in bonds, then you could do it. And if you want to invest 100% of your money in stocks, one particular stock, you can do it. If you want to invest it in 100 different stocks, then you're able to do that. And in subsequent videos, we're going to speak specifically about how to open up a brokerage account and how to look at different stocks, or in this case, it's going to be index funds to invest your money in. For the individual retirement accounts, there are limits just as in the 401k, and you can only put $6,000 into an individual retirement account if you're younger than 50 years old. And if you're older than 50 years old, then they allow for a catch-up of $7,000 as a maximum contribution. Now, this is significantly lower than the 401k contribution limits, which are $19,500. And the difference between a traditional IRA and a Roth IRA, there are income limits. So that's the bummer. So contributing to a Roth IRA is golden. So if you are under the income limits, then you definitely want to contribute to a Roth IRA, because you're paying taxes on that money now. And we don't know what's going to happen in the future. Maybe you're going to be a millionaire or a billionaire, and to pay taxes on the money that you're withdrawing later on means that you're going to be at a higher tax bracket and have to pay more taxes then. Also, we don't know what the tax brackets are going to be. And when it's time for you to make withdrawals from that money, you actually are subject to higher income tax. Therefore, I always recommend that if you can contribute to a Roth IRA, then you definitely want to contribute to a Roth IRA. Another benefit besides paying taxes on that money now and allowing it to grow tax-free, so when you make the withdrawals, you don't have to pay any money. Like, that money that is there in the account is yours. You don't have to pay any taxes on it. But another benefit of a Roth IRA is that you do not have to withdraw the money at any time. That money grows tax-free, and it is a nest egg, or it is a gift to your heirs. It is not subject to required minimum distributions as the other retirement accounts. For the income limits of a Roth IRA, you want to check every year, because each year is different. And it depends on your marital status and also your filing status. So make sure you look each year to determine what the income limits are for the Roth IRA. Now, if you are a high income earner like me, there is a such thing as a backdoor Roth IRA, which makes the process a little bit more complicated. However, there is a way that you can make contributions to a Roth IRA if you are a high income earner. However, it takes just a few extra steps than opening up a brokerage account in a Roth IRA. Another benefit of a Roth IRA is that you can withdraw your contributions at any time. So say, for example, in my daughter's case, we have contributed $5,000 to a Roth IRA. Now, my daughter is only 2, so that money is just going to have so much time to continue to grow, and by the time she retires, she'll likely have $500,000 plus if we don't make any other contributions. Now, say for example, she's getting married and she wants to use some of the money that we've contributed to our Roth IRA for her wedding. She can withdraw that $5,000 without having any penalties or having to pay any taxes on that money. Now, any growth on that money, she will have to pay penalties if she were to withdraw it prior to age 59 and a half. But whatever you contribute to a Roth IRA, you can withdraw tax and penalty free. Now, I've said a lot, so let's compare and contrast each account. The Roth plans are after-tax dollar contributions, and the traditional plans are pre-tax dollar contributions. They both have income limits. The 401k have an income limit of $19,500, and the IRAs have income limits of $6,000 or $7,000 depending on your age. All of the accounts are tax advantaged, meaning that your monies grow tax-free. And for the Roth IRA only, there is no required minimum distribution. Now, I told you that I would give you a few tips about which retirement plan is right for you. If your employer offers a match, then you definitely want to contribute up to that match. So in our example, we had an employer who contributed dollar for dollar up to 3%. So for you, you would want to log into your benefits platform for your employer and set your 401k contributions to 3% of your salary so that you can maximize or receive the full match. And if you have any questions regarding if your employer offers a match, how much is the match, how much you need to contribute, then please right now stop this video and get on the phone with your HR representative so that you can have clarity around how much you need to contribute in order to receive the full match. It's free money, so don't leave any money on the table, okay? If you are under the income limits for a Roth IRA, after you have maxed out your retirement 401k match, then you should make monthly contributions to a Roth IRA. Remember, these are after-tax dollars, and we don't really know what's going to happen in the future. Also, any contributions can be withdrawn for any of your needs. Maybe you want to buy a home, you want to pay for education, things of that nature. And it is not subject to required minimum distributions, which means that you can grow your nest egg and you can leave it for your family, for your granddaughter, for your grandson, for a niece or nephew. And so that is the benefit of a Roth IRA. So if you do not exceed the income limits of a Roth IRA, you definitely want to maximize your Roth IRA. And after you've maxed out your Roth IRA, if you determine that you still have money left to contribute, then max out your 401k beyond what the contribution would be to receive the full match. Now, if your employer does not offer a match, I would say to contribute directly to the Roth IRA and max that out first. So contribute the full amount that you can, that's $6,000 or $7,000 depending on your age, to your Roth IRA first. Because remember, the Roth IRA has so many more benefits than traditional IRA or the Roth 401k or traditional 401k. After you have maxed out your Roth IRA, then you can contribute to whatever your employee sponsor plan is, even if there's not a match. The more money that you can save for retirement and it's growing tax-free, the more your future, more mature self will thank you. So if this was helpful, make sure you hit the subscribe button down below so that you can get more of the videos regarding how to invest and how to invest simply. I mean, I'm a mother of two, and so I don't have time to be researching and picking stocks. So I do things as easily as possible. I'm all in working smarter than working harder. And I'm going to teach you how I continue to grow my money, how I invest, and build generational wealth without spending tireless hours doing so or actively trading. That's not something that I would do. So I'm hoping that this was helpful for you guys. It gave you some clarity around how you should contribute to either your employee sponsored plan or the self-directed plan, and also to empower you that investing, even in a target retirement fund, is still investing. You are still saving for retirement and growing your money. That is the whole idea. So if you want to learn more, definitely hit the subscribe button that we can have more joy and more wealth in our lives. And this is through better money management. So I will see you guys next time. Thanks for watching.